Guys, we have received a question from Joe, all the way from Dublin, Ireland. And I thought that it is a good opportunity for us to share our answer and the information, since I believe it is also useful for the other business owners out there in the community. So Joe basically wants to know what key ratios should he be on the lookout for when assessing a company's performance? Okay, well, basically there are many financial ratios and metrics that can be used, and it all again depends on the type of business and the industry that the company is operating in. Okay, so the most commonly used, I will quickly describe it today in this video. The first one is basically the debt to equity ratio, also known as gearing in layman's terms. Now this basically measures the company's financial leverage and indicates the proportion of equity and debt that is currently being used by a company. This metric is basically generally computed by taking the company's total liabilities and divide that by the total shareholders' equity. Now here, total liabilities include all of the liabilities on the balance sheet. Okay. A lot of times we also want to know the gearing levels based only on financial loans outstanding. If this is the case, you will include only the total outstanding loans, take that number and divide that by the shareholders' equity. Another version of this is what we call it as a net gearing ratio, which is computed by taking the total loans outstanding at the balance sheet date minus the cash available again at the balance sheet date, and divide that by the total shareholders' equity. Now for any of these three versions that I've just described, the higher the resulting number means the higher the leverage that is being used by a company. That means the debt element of the company's capital is higher. Okay. Next is the current ratio. Now this ratio effectively indicates the company's ability to meet its short-term obligations. Now this typically means those obligations that fall due within one fiscal year or 12 months. The current ratio is computed by taking the total current assets on the balance sheet and divide that by the total current liabilities as at the balance sheet date in question. Okay, and of course, the higher the resulting number, the better. All right. Now this current ratio can be tweaked slightly to arrive at what we normally call as the acid test ratio, also known within the industry as quick ratio. Now this ratio indicates the company's ability to meet its short-term debts using only its most liquid assets. Now what does it mean by liquid assets? Basically it means those assets in the current assets section which are easily convertible into cash within probably a period of 90 days. Okay. Now this is computed by typically taking the company's total current assets minus those illiquid ones, typically inventory, for example, and any prepaid expenses, and divide the resulting number by the total current liabilities. Okay, so far so good? Right. The next ratio is the ROE, or return on equity. And this basically measures the amount of net earnings generated by a company or a business as a percentage of the shareholders' equity, which is basically how much money that the shareholders have invested into the business. So basically you take the net profit after tax and divide that by total shareholders' equity, and you multiply that by 100 to arrive at a percentage figure. Again, the higher the ROE basically reflects that the shareholders are getting better returns for their buck. All right. Now, to measure the efficiency of the company, we should also look at a few ratios based on the profit and loss account. I call it the P&L ratios. Okay. An important one will be the net profit margin, which is your net profit after tax divided by total sales, again reported in percentage terms. Then you can also take this number and compare this and benchmark it against your competitors and other players within the same industry, within the same market. What this will do is basically help you to examine the competitiveness and the cost structure of your company or your business. Other P&L ratios that you could look at is things like interest coverage ratio, which effectively measures how well the company can pay interest on its outstanding loans. This can be derived at or computed by taking the earnings before interest and tax, also known as EBIT or EBIT, and divide that number by the interest expense for the period under review. Typically, an interest cover lower than 1.5 times, for example, is not particularly satisfactory. Okay, so a higher number is definitely better. Now, banks or providers of capital will probably look at this ratio to assess a company's ability to meet its debt obligations as well as their repayment capacity. One final tip is to also have a look at periodic variances. For example, month-on-month fluctuations or month-on-month variance in sales, expenses as a percentage of sales, and also your bottom line earnings. And do zoom in on any major variances to see if those variances are actually justified. Okay, Joe, so I hope that answers your questions. Thanks again for sending us your question. And to the rest of the guys out there, hopefully this video is of some help. Again, do keep those questions coming, and we will do our best to revert soonest possible. Thank you and take care.